Namaskar. In this video class, we are going to discuss the measurement of national income value added method. We are going to discuss the value added method of measurement of national income. First, the learning objectives of this video lesson. At the end of this lesson, the learners will understand the various steps involved in the measurement of national income. The learners will be able to calculate the value added, and the learners will also be able to analyze the precautions involved while calculating national income in value added method. In the methods of measuring national income, we have three methods: the product or value added method, income method, and the expenditure method. First, we are going to discuss the value added method or the product method. Before studying the steps involved in the measurement of national income by value added method, first let us understand the meaning of value of output and value added. What is value of output? It is the market value of all the goods and services produced during an accounting year. It is the market value or the money value of all the goods and services produced during 1 year, that is from 1st April to 31st March. How to calculate value of output? Value of output is equal to sales plus change in stocks. A firm manufactured 1,000 pairs of shoes. The price of one pair of shoe is rupees 500. Of the 1,000 shoes, it sold only 800 pairs, and 200 pairs are with them as a stock, unsold stock. Now, how to calculate value of output? So, the value of output is the sales made by the firm plus the value of unsold stock with the firms. You can see here, the sales is the quantity sold, the number of units sold into price per unit of a commodity. 800 units sold by the firm. The price of one pair of shoes is 500. So you will be having the total sales as 4 lakhs. And the change in stock, we consider it is a change in stock. 200, price per unit is 500, is 1 lakh. So the total sales, the value of output will be sales plus change in stock, that is 4 lakhs plus 1 lakh, that is 5 lakhs. The total value of output is 5 lakhs. Suppose entire output is sold, imagine all the 1,000 pairs of shoes are sold, then the value of output would be equal to 6. Or otherwise, we have to find out the sales and the value of stock. So the value of output is equal to sales plus change in stocks. Next concept, the meaning of value added. It is the net contribution made by a firm, or it is the a difference between the value of output and the intermediate consumption. It is the value added by a producer to the production, to the flow of goods and services. Value added by a firm, value added by a firm in the production process. That is value added. How to calculate this value of output minus intermediate consumption? So value added is equal to value of output minus intermediate consumption. So the value added is also known as gross value added market price. This would be helpful to calculate the value added. The other name of gross value added market price is value added. For example, how to calculate the value added? Suppose a baker purchased wheat flour for rupees 300. A baker purchased wheat flour for rupees 300. And he converted this wheat flour into bread and sold for rupees 500. Then the actual value added by the baker is rupees 200 because he purchased wheat flour for 300. He added value into that 200. So the value added will be 200. So how to calculate the value added is value of output minus intermediate consumption. That is 500 minus 300 is equal to 200. You can see this example. Value of output is given, intermediate consumption is given, value added is there. So value of output is 500, intermediate consumption is 300, so value added will be 200. So value of output minus intermediate consumption is equal to value added, right? Likewise, you can find out the total value of output is 800 and the intermediate consumption is 500 and the value added is 300. Now, what are the steps involved in the measurement of national income with the help of value added method? In value added method or product method, we calculate the total money value of goods and services. Here, the national income is calculated on the basis of the total money value of goods and services produced in a year. First step, we have to identify the industrial sector and classifying the production units into industrial sector. The previous class we studied industrial sectors are primary, secondary and tertiary. Various production units on the basis of the nature of the industrial sector are to be classified under these three sectors: primary, secondary and tertiary. Say for example, forestry to be classified into primary, manufacturing to be put under secondary, transport is to come under the tertiary sector. So like that, we have to classify the production units into various industrial sector. That is the first step. Then next one is, for each sector, estimate value added of each sector. So value of output minus intermediate consumption is equal to value added that we have to find out. Third step is net value added factor costs. Net value added factor costs. Here, We have already calculated value added. This value added minus depreciation is equal to net value added market price. Ultimately, in value added method, we have to find out net value added factor costs. So net value added market price minus net indirect taxes is equal to net value added factor costs. Then afterwards, we can find out NDPFC. NVAFC, NDPFC. The difference is NVAFC for a sector, NDPFC the sum of all the sectors in the economy. We calculate net value added factor costs for a sector, say for example a primary sector. Then we add the net value added of primary sector, secondary sector and tertiary sector, then we will be getting NDPFC, net domestic product factor costs. NVAFC is net value added factor costs. So the sum of NVAFCs of all the firms or all the sectors in the economy is equal to NDPFC. Then lastly, how to estimate national income. Add net factor income from abroad with the NDPFC. Net factor income from abroad with the NDPFC, we will get national income. So NDPFC plus NFIA is equal to national income. The other name of national income is NNPFC. So here in the steps, first we are classifying the sectors, then we estimate the value of output by sales and the change in stocks, then value added, then net value added market price, then net value added factor costs. If we add the net value added factor cost of all the sectors in the economy, we will get the NDPFC, net domestic product factor costs. Then lastly, with the net domestic product factor costs, if we add the income from abroad, net factor income from abroad, we will get national income. Just I want to revise the things which we studied in the last class before calculating the value added. Always keep in mind that the difference between gross value and net value is depreciation. So the gross value minus depreciation is net value, and the net value plus depreciation is gross value. Whatever may be, say for example, gross value at market price minus depreciation is equal to net value added market price, or net value added market price plus depreciation gross value added market price. We know very well how to calculate market price. Market price minus net indirect tax is equal to factor costs, and factor cost plus net indirect taxes is equal to market price. This is the example. Then the difference between the how to calculate net indirect taxes. Indirect taxes minus subsidies. How to calculate change in stock. Closing stock minus opening stock. Value of output, sales plus change in stock. Value added, value of output minus intermediate consumption. All these things we have studied in the last class. Just I am reminding you here. Now, how to find out where that is value added here? First thing is value of output. Value of output is equal to sales plus change in stocks. Then value of output minus IC is value added. Right? Then GVAMP means value added minus depreciation is equal to net value added market price. Net value added market price minus net indirect tax is equal to net value added factor costs. Or we can calculate like this also. As I told you earlier, value of output, the same value added. There only one change is that earlier you can see that here GVAMP minus depreciation was there is equal to NVAMP. Here GVAMP minus net indirect taxes. So GVAMP minus net indirect taxes GVAFC. Only small change. Anyway you can do it. Then GVFC minus depreciation is equal to NVFC. Lastly, we have to find out this NVAFC. Or if you know very well, if you practice more, you can calculate value of output is equal to sales plus change in stocks minus intermediate consumption minus depreciation minus net indirect taxes. You will get net value added factor costs. Right? The the formula which we studied is given in this picture. Same thing is given value of output, then value added, then GVAMP, then NBFC of all the sectors. Then last you have to calculate national income. Now, let us have a numerical example. We have to find out GVAMP. As I already told you, the other name of GVAMP is value added. You know very well. The formula for value added is value of output minus intermediate consumption. Right? Value of output is equal to sales plus change in stock. Please find out. Sales is 350. Closing stock minus opening stock 30 minus 20. Let us see what is the value of output. 350 plus 10, that is 30 minus 20 is equal to 360. Then value added or gross value added market price, value of output minus intermediate consumption, that is 360 minus 130, that is the purchase of raw materials. Purchase of raw materials is also known as intermediate consumption here. Purchase of raw materials to be taken as intermediate consumption. So value added or GVAMP is 230 lakhs. Right? So likewise, we will have another example. Here we are calculating NVAFC. I would like to remind you again, value of output is equal to sales plus change in stock. Next one is GVAMP is equal to value of output minus intermediate consumption. Next one is NVAMP, GVAMP minus depreciation. Next one is NVAFC, NVAMP minus net indirect taxes. You will be getting NVAFC. Let us see. The sales is 800. The change in stock, closing stock 20, opening stock 50. So 800 minus 30 is 770. Next one is value added, value of output minus intermediate consumption, 770 minus 500. 500 is the intermediate inputs, that is intermediate consumption, 270. Then GVAMP minus depreciation is NVAMP, 270 minus 30 is 240. Now, lastly, NVAMP minus NIT is equal to NVAFC, that is 240 minus 20 is rupees 220 lakhs. That is the NVAFC. Right? So, once you understood correctly, you can write value of output is equal to sales plus change in stock minus intermediate consumption minus depreciation minus net indirect taxes. Right? So this question is given for you to practice. right? The answer is also given. Practice it. Then, lastly, we are going to find out, study the precautions of value added method. The first one is that what are the precautions we have to undertake while calculating value added method? The value of intermediate goods are not to be included because the value of intermediate goods are already included in the value of final goods. That's why we should not include the value of intermediate goods anywhere. Sale and purchase of second-hand goods are not to be included. I will give you an example. I purchased a car for rupees 5 lakhs last year. The production value of rupees 5 lakhs was already included in the last financial year. This year I am selling the same car to 4 lakhs. This 4 lakhs not to be added in the national income because it will be a double counting. Reason is that already we have included the value of this good in last year, so that's why the second hand sale of the value of second hand sale of any good not to be included, otherwise it will be a double counting. That's why the sale and the purchase of second hand goods are not to be included because the value of these goods are already included in the year these goods were produced. Production of goods for self-consumption to be included. I will give you an example. A small farmer, a small piece of land, he cultivates wheat. He is not selling in the market and he is keeping the whole wheat for throughout the year consumption. So, the value of the goods which he kept for self-consumption to be included in the nation. That's why production of goods for self-consumption to be included in the value of national income. Imputed value of owner-occupied houses are to be included. Say for example, a house owner has two houses, identical houses, assume. In one of the houses, the owner is living. In another house, he gave rent for rupees 10,000. Right? So the value of 10,000 is already included in the national income. But the value of owner-occupied houses also to be included. Though the owner is not paying rent to anyone, but the house occupied by the owner also produces the value worth of rupees 10,000 house, 10 rupees 10,000. That's why we have to estimate the value for the owner occupied houses and that value also to be included in the national income. Right? So let us recall what we have studied. What is the difference between value of output and the value added? The answer is intermediate consumption. How to calculate value of output? Sales plus change in stocks. What is the difference between gross value added market price and net value added market price? The answer is depreciation. Then, why sale and purchase of second-hand goods are not included in national income? Because the value of these goods are already included in the year these goods were produced. Thank you very much.